Well, hey there. It's Thursday, so that means it's time for 3-Minute Thursdays. I'm Terry Sawchuk, and today I really want to talk about all the craziness that's been taking place in the markets. Really over the weekend, the futures opened Monday down 1,000 points. The VIX index spiked to 60, which is crazy. VIX is the volatility index, and it went from basically less than 20 to 60 in one day, which is the biggest recorded single day jump in history. And it started because over the weekend, there were some, we'll call them institutional investors that it's speculated that it blew up, basically, that just lost a whole bunch of money and maybe got put out of business because they were doing something called a carry trade, which has to do with the Japanese yen. I'm not going to go into a lot of detail with it, but what I do want you to see is that over a relatively long period of time, this goes back to the beginning of 2023, the Japanese yen just kept getting weaker and weaker. There was a little bit of a dip here where it went back up, then weaker, and then you can see right here, it absolutely blew up in, a matter of just a couple of weeks. And it virtually wiped out a year's worth of gains, and it happened so rapidly that it caught a bunch of people off sides. The Bank of Japan decided to begin to strengthen their currency, and what happened is it created a lot of liquidations, forced sales. Now the market has since kind of calmed down. If you look at the S&P 500, a couple things that stand out to me here. Okay, one is that if I stretch this out, you can see that off the bottom on Monday, we've bounced a little bit, so there's been a little bit of a orderly recovery. But you can clearly see that this was a long-term uptrend, and we've since broken that. And so when I look at this chart, what I'm seeing right now is the potential for a series of lower highs and lower lows. So it went down, then it went up, then it went down, then it went up. My guess is that this bounce that we're experiencing here might only get up somewhere into this area, right? And then we start another leg down. And part of this is because from a sentiment standpoint, I don't think that we've entirely erased the concern that this is all just a short-term blip and it's over. I think there's more to be had. And if you look at, we got close to the 200-day moving average and we bounced. I would bet we're going to go and touch that. On the NASDAQ, we actually broke below it briefly, have come back above it. But again, this looks like the formation of basically a lower high, which means we're at least going to go test this level, if not go lower. There's no guarantee that's going to happen. This is technical analysis. Just because it looks that way in a chart does not necessarily mean that it's going to behave exactly the way that we expect. But my perspective is that the market was overvalued, the AI stocks were overvalued, and we were due for a correction. And things tend to go a little bit more in each direction than you think they will. And so I think between now and the next Fed meeting in September, we've got room for more volatility. We might get a short-term bounce, but it's probably going to be followed by another leg down. And the market's definitely begging for a rate cut from the Fed. They're probably going to get it in September, but the question is, how much damage between now and then will be done? And the answer is, I don't know. Nobody does. But I will tell you that this is the kind of thing that we were prepared for. We had a feeling that this was coming. We've hedged all our equity positions, so this just creates a buying opportunity for us. And if it goes a lot deeper, we're going to be in a really good position because we've got a lot of hedges in place and we were pretty conservative. This also, I want to remind people, I don't generally, clients don't get upset with us and leave when the market is doing poorly. What happens is they tend to get a little frustrated if we're not participating to the same degree that the market is as a whole. And so what I would say is this, I've been getting quite a few calls from people that are telling me that they, think that we should be more aggressive. And I will tell you that is precisely the time when you shouldn't be. So with that said, a little longer than 3 minutes this week, but a lot's been going on. I just want to tell you that we remain cautious, that there's probably more downside, that our clients are in great shape because we were expecting this, and certainly this has created some opportunities for our hedge and harvest program, and we've certainly been doing that. And we've got a lot of dry powder on the sidelines, so if we get a much deeper correction, we'll have a lot of cash to buy with. So with that said, thanks for listening. We'll see you again next week.